Hope everyone is doing well, and welcome to CEPR's first Associates event of 2023. I'm Mark Duggan, the Trione Director of the Stanford Institute for Economic Policy Research, and it's wonderful to welcome you here to CEPR today. And I'm thrilled to kick off this calendar year's Associates event series with Bo Lee, the Deputy Managing Director at the International Monetary Fund. And as many of you know, we at CEPR are deeply committed to bringing some of the most influential people in economic policy making and the business world to CEPR. A very important part of our mission is to work as a convening place. And now that we're able to come together again in person regularly, I'm looking forward to ensuring that our CEPR-affiliated faculty, many Stanford students, CEPR supporters, and others in our community have many opportunities to hear from and connect with people like Bo Lee. Many of you should have already received invitations for our annual economic summit on Friday, March 3rd. And if you haven't, and if that's an event you'd be interested in attending, please let us know. We have a terrific lineup for that day's events, with the day starting off with former Secretary of State Condoleezza Rice, and wrapping up with former Secretary of the Treasury Larry Summers, and many really interesting sessions during the day on topics including China's relationship with the US, energy and sustainability, the future of technology, and the impact of the world's rapidly changing demographics. We'll also have a lunch keynote by the president of the Richmond Federal Reserve Bank talking about monetary policy and Federal Reserve policy. Obviously, pretty important topics right now. We hear a lot about that every day in the news. You can find more information about the summit and our other upcoming events, as well as plenty of examples of our latest research and policy briefs on our website at cepr.stanford.edu. And today, I'm so honored that Bo Lee is joining us to talk about a topic that is incredibly timely, regulating crypto. Many of us have been pretty riveted by the dramatic collapse of the crypto platform FTX and all of the subsequent fallout and investigations that have come over the past few weeks. And I'm sure we'll be hearing much, much more about that in the weeks ahead too. But beyond those headlines, crypto's use and regulation have been taking hold around the world for several years now. And policymakers like Bo Lee are working on ways to find the optimal mix of regulations that will balance innovation with reasonable guardrails. Some countries are already doing a good job of striking that balance, and some have banned it altogether, while a few on the opposite end of the spectrum are using crypto as legal tender. And others are using crypto to dodge international sanctions. So we have a currency and an asset that holds tremendous promise, but also creates a lot of important legal and economic issues that need to be thought through. And it's great to have Bo Lee here to walk us through some of these issues. Bo Lee took his role as the IMF's Deputy Managing Director, I believe it is exactly 17 months ago today, on August 23rd, 2021. He oversees the IMF's work in about 90 countries, including the US, and countries in pretty much every other continent. His portfolio includes crypto policy and a wide range of other policy issues. Before joining the IMF, Bo worked at the People's Bank of China, most recently as deputy governor. He also played a hugely important role in the reform of state-owned banks in China, the drafting of China's anti-money-laundering law, the internationalization of the renminbi, and the establishment of China's macroprudential policy framework. Outside of the People's Bank of China, he was the vice mayor of, I'm going to pronounce this incorrectly, I'm sure, Chongqing. Okay, yeah. China's largest municipality with a population of more than 30 million, where he oversaw the city's financial sector development, international trade, and foreign direct investment. He was also vice chairman of the All China Federation of Returned Overseas Chinese. He started his career at the New York law firm of Davis, Polk, and Wardwell, where he was a practicing attorney for 5 years. He is no stranger to Stanford. He has spoken here a few times over the last 15 or so years, and he also received his economics PhD here at Stanford. And I just learned that one of his advisors was my colleague, Paul Milgram. And it's a tremendous honor to have Bo with us today. And I'm about to turn things over to him. But after he gives his presentation, I'm going to ask Bo a few questions, and then we'll have time for a Q&A session. So I may mix it up. I may go back and forth between my question, your questions, so forth. So please brainstorm some great questions for him during and after the presentation, because I will admit that crypto is not in my strike zone of expertise. So this is like a little outside my comfort zone today, but that's what you need to do as CEPR director, is sometimes stretch yourself. So with that, please join me in welcoming Bo Lee to CEPR.
Thank you, Mark, for that generous introduction. It's very nice to be back after more than 3 years of COVID. Last time I was here was 2019. The summer of 2019, I was here, gave a presentation on WTO reform in China. Today, I'm here to introduce a new topic, crypto. It's new to me as well, because before I joined the IMF, I was not heavily involved in the regulatory discussion internationally. But in the last 17 months, I was fortunate enough to be able to join a lot of this international discussion on crypto. And of course, given the recent event, it is also a topic that many of you are also very interested in. Very happy to be here with see my former professor, many of my friends here as well. So what I plan to do in the next 25 to 30 minutes is to give a framework of thinking about crypto from economic perspective. I'm an economist and a lawyer, so I don't know technology very well. So if you ask me technological questions, I will try to not answer it, because I don't know. But I want to give a little framework thinking about crypto from monetary and financial policy perspective. And I don't pretend I know all the answers. In fact, we don't know the answer to many of these questions I will raise tonight. But hopefully with some enlightened discussion, we can ask the right questions and also start to think about some possible answers. So the crypto debate, I summarize them in 3 questions. What is crypto? Why do we need to regulate crypto? And how to regulate crypto? So the first 2 questions I will go through very quickly. I assume many of you know more about what is crypto than me. And also the question of why, I will also try to go over quickly. My focus will be on the 3rd question, how to regulate crypto. So there are 3 key features of crypto assets. Cryptography, that's a technology. Tokenization, that's also a technology. And common ledger, of course, some people would argue it's distributed ledger, DLT. And also some people argue it doesn't have to be distributed. It can be a centralized ledger. So there are disagreements in terms of how to define crypto. And typical crypto, of course, as many of you already know, unbacked Bitcoin, a backed crypto like stablecoin. Back means there is collateral, there is reserve that's supporting the value of the crypto. But unbacked means there is nothing on the asset side to support the value of the crypto. But also, of course, there are also other crypto that are also in the making, like a digital stock, digital bond, basically the digital version of existing financial assets. So the current regulatory landscape, as Mark already alluded to, at one extreme, some countries make crypto their legal tender, like El Salvador, like Central African Republic. Another extreme is completely banned crypto, like China, like Egypt. Of course, most countries are in the middle. Most countries are trying to figure out how to regulate. And they start from limiting exposure of traditional financial institutions to crypto. They also try to put together guidelines, rules, and regulations, including the recent regulation on crypto put out by European Union, the recent report by the US President's Working Group on stablecoin ecosystem, and also the enforcement actions by the US SEC and CFTC. And some countries like UK and Japan, they try to have some targeted ban on crypto. For example, they would ban derivatives based on crypto. So what are the regulatory challenges? I summarize them in four: centerless, faceless, permissionless, and borderless. So crypto is very hard to regulate because there is, unlike traditional financial assets, many of them don't have issuer and is completely decentralized. They are faceless because a lot of people use their pseudo names to buy or sell crypto, and there is no requirement for client identification as traditional banking or traditional financial services. Permissionless, you don't have to get permission to become a major player, to become a validator, for example, on the blockchain. Borderless is naturally born without border. I mean, the entire infrastructure, architecture is not based on traditional country boundaries. So that's what. The second question is why? Why do we need to bother? Some people say, let them burn. Those technology is useless. Or their potential benefit is minimal, but potential risk, potential damage could be tremendous. So some people argue, let them burn. Don't let them into the house. So what's our take on this? I think many countries realize that we probably cannot let them burn because they may burn down our house if we ignore them. There are direct costs of inaction, just like the recent case of FTX. There are also opportunity costs because if you don't regulate them, they won't have access to the millions of customers and investors in the traditional system, and some of their benefits may not be realized. And there is a hope that crypto can provide cheaper, faster, and safer financial services if properly regulated. And of course, some people argue we should just allow the traditional financial institutions to adopt crypto technology. Instead of letting the technology company, letting the non-traditional players into the house, we should just ask banks, ask the existing financial institutions to adopt crypto technology. Why that approach may not work or may not be sufficient? I think one reason is that we realize when you have innovation, you need use cases. And traditional financial institutions, they don't have use cases outside traditional financial services. And we see that in China very vividly. Alibaba, Tencent, they brought so many new use cases into financial services that traditional banks, they do not have the network, they do not have the use cases. So if you want to allow innovative financial solutions, you may want to allow non-traditional players into the house. And it may not disappear if you ignore them. Because some people say, oh, this crypto is purely gambling. Why should we care? Because people like gamble. You ignore them, but people continue to gamble, right? So it will not disappear if you ignore them. So all these reasons combined, I think many countries agree that we should not ignore them. We should think about how to regulate them. So here comes my final question, which is my focus. How to regulate them? They are posing a lot of challenges to traditional financial regulation because traditional regulation is based on real name, client identification, with a centralized system dominated by central banks. We have a decentralized asset like crypto, how can we regulate them? So let's start with some basic principle of regulation. I put two here. One is level playing field. Same activity, same risk, same regulation. That includes prudential regulation, include conduct regulation, and include integrity, anti-money laundering, for example. The second principle is you want to balance encouraging innovation versus safeguarding financial stability and integrity. We need regulatory clarity if we want to encourage innovation. We also need to think about proportionality. So the kind of regulation we put together has to be proportional to the risk and to the capacity of the regulator. And we also have to do this with a sense of humility because regulation always lags behind innovation. So we have to do it with a sense of humility. We may not, most likely, we may not be able to get ahead of market. We have to learn from market. And sometimes for technology and innovation that we do not know how to handle, we may want to try use something called a safety box or experimental box for innovative services that we do not know yet what's the best way to regulate. We may do some kind of controlled experiment. So let me use a simple metaphor to describe what I have in mind or what we have in mind in terms of regulating crypto. So this is a house of finance, right? So there are banks, there are asset managers, investment banks, insurance companies, and commodities market. And crypto right now is in the wilderness, not in the house yet, not even in the yard, right? So our question or our challenge is, do you want to allow this crypto, this new animal into the house? And under what condition we would allow this crypto into the house? And if we let them into the house, which room we should let them in, right? We have different rooms in the house. We have monetary and banking room, right? We have capital market and asset management room. We have commodity room. We have insurance room. So we have different rooms within the house of finance. So our challenge, our question would be, what kind of hurdle, what kind of condition we want to impose on crypto if they want to enter into the house? And why would they want to enter into the house? Why would they just stay in the wilderness? Because they want to access the millions of customers, the millions of investors in the house. And if you don't comply with the regulatory rules, you won't be able to access such large number of mainstream investors and customers. So there is an incentive for crypto to get into the house. So if they have the incentive, let's think about what kind of hurdle we want to impose, what kind of condition we want to impose, and which room we should let them in, right? Because different rooms have different regulatory standards and regulatory rules. So for me, the progress so far, there are a lot of international bodies trying to work on crypto. These are all international standard setters. CPMI, the Committee on Payment and Market Infrastructure based in Basel, FSB, Financial Stability Board, BCBS, Basel Committee on Banking Supervision, and IMF. We have been working hard in the last several years trying to think about crypto and trying to find a global consensus on how to regulate crypto. And so far, the progress I can report is that we have come together with some high-level principles. And there are 9 recommendations from SSB on crypto asset ecosystem. There are 10 recommendations from FSB on global stablecoin, for example. But these are all very high-level recommendations in terms of regulatory coordination, in terms of regulatory clarity, etc. Very high level. And IMF ourselves, we are also working very hard. We wrote a number of analytical paper and blogs on crypto. And next month, we're going to have a paper sent to the board of IMF on 9 elements of effective policy for crypto assets, including macro-financial aspects, legal and regulatory aspects, and international aspects. Again, these are very high-level principles, high-level recommendations. So what's ahead of us? Because given this high level, this very abstract, they will say, we need to have strong regulatory coordination. We need to, think about what's the potential impact on monetary policy, on monetary sovereignty, etc. And we need to provide legal certainty to crypto. So all these are very high level. So today, what I want to do is I want to, from the high level principle, I want to get on the ground. I want to ask, what are the key questions we need to ask if we want to allow this animal get into the house, right? So I think there are 3 key questions we should ask. The first question we should ask is this animal money? Is it money? The second question we should ask is, if it is not money, is it security? And the third question we should ask is, if it is not security, is it any other regulated animal like commodity, right? In this country, in the US, there is a Commodity Exchange Act, right? And in some other countries, in countries like Japan and China, we have regulation on derivatives, on futures. So I think these are the key questions we need to ask if we want to think about bringing the animal into the house. And I want to focus on these 3 questions in the next 10 minutes. So first question is it money? Is crypto, because crypto, sometimes they use the term cryptocurrency, right? Cryptocurrency. This is a misnomer because they're not really currency, right? They may be currency in the crypto world, but they're not currency in our ordinary life, right? So cryptocurrency, we have to ask, is it really currency? Is it really money? So I want to briefly touch on how to think about crypto from a monetary perspective. Let me quickly go through several concepts. So money, what is money? Money is a medium of exchange, unit of account, and store of value, right? But in the modern monetary system, money is either central bank liability or commercial bank liability, basically. Think about the M0, M1, and M2, right? They're either central bank liability or commercial bank liability. That's money. So that's the economic perspective. What about legal perspective? Currency, what is currency? Currency is mostly associated with official means of payment, basically banknotes and coins. So there is a strong official or governmental element in currency. And money is broader. Money includes not only currency, but also include liability of banks that can be converted into currency, right, easily, just like bank deposit, right? So money is broader than currency. And what is payment instrument? Payment instruments are used to effect or facilitate the transfer of money. For example, cash. Cash is both money and also payment instrument. Checks, credit cards, they are payment instrument, but they are not money per se. And I also define a concept called widely accepted payment instruments. That means a payment instruments that are widely accessible and widely accepted for general purpose payment. So all the cryptocurrency right now, they're not really currency because they are not widely accepted as a payment instrument. So for us, the challenge is, so non-stable crypto like Bitcoin, are they money? Based on the definition I just provided? Of course not, right? Because they're not accepted outside the crypto world as a payment instrument, not as a medium of exchange in our ordinary life, right? So Bitcoin is not money, and Bitcoin is not currency. How about stablecoin? Is stablecoin money? Not yet, right? Most of the stablecoin we see today, they're not really stable, right? they're not really stable. And they are not widely accepted as a payment instrument, right? So the question to us as a regulator would be, what kind of stablecoin can be money? What kind of condition we want to impose? If a stablecoin want to become money, what kind of condition we should impose? What kind of hurdle we want them to jump if they want to become money, right? So that's the question I want to ask. So in order to answer that question, I want to briefly review the existing literature on private money, right? Because if stablecoin become a money, it's private money, right? Because stablecoin is privately issued. So there are a very good literature on private money. So Holmstrom, our good friend Holmstrom, his famous paper in 2015 says that debt is money only if agents accepted NQA. What's NQA? No questions asked. So what does NQA mean? That means a debt, a privately issued debt, is money only if agents accept this instrument at par. At par, that means if the par value is $100, they accept it at par without reservation and without costly due diligence. So that's NQA. The second paper by Holmstrom in 2018 says that optimal design of private money is debt backed by debt. What does that mean? Debt backed by debt. So if you think about bank deposit, right? That's money. Bank deposit is part of the broad money, M2, right? So bank deposit is money, and it's backed by what? It's backed by deposit insurance. And deposit insurance is what? It's obligation of the government, right? So you can think of bank deposit is a debt. It's a liability of a commercial bank. And it's backed by deposit insurance, which is a government liability. So it's liability backed by liability. So that is, bank deposit is a widely accepted money, right? So the next paper by Gorton, Ross, and Ross says that they found no example of widely circulating private money that is NQA without government backing, either implicit or explicit. So basically that paper says that historically money that is NQA is a public good that only the government can supply. So if stablecoin want to become money, according to the authors, stablecoin may need a government guarantee to become NQA. And to become NQA means to become money, right? Because if you are NQA, you are money, right? That's the definition that Holmstrom in 2015 provided. So the question now to us is, what kind of government backing is needed for crypto, for stablecoin to become NQA? Or to become money? Or to become WAPI, right? Widely accepted payment instrument. So there are three options I provided here. As I said, I raise questions and I provide possible answers, but I don't know which one is the best. Maybe I will take a poll after I finish this slide, right? So the option one, if a crypto asset is backed by highly rated and liquid money market instruments, would that be enough for this crypto to become NQA? The second option, what if it is backed by insured commercial bank deposits? Would that be good enough for this crypto, for this stablecoin to become NQA? The third option, backed by central bank reserve. Would that be good enough? I mean, central bank reserve is a central bank liability, right? It's what we call base money, right? It's high power money. So the EU regulation basically says that a stablecoin must be backed by highly rated and liquid money market instruments. Of course, the EU regulation doesn't say, okay, if they have this backing, this stablecoin can become money. The EU regulation only says any stablecoin, if you want to become a stablecoin, it has to be backed by highly rated and liquid money instruments. My question is a little different. My question is, does that make, if they have this backing, if they have option one, does that make this stablecoin money? That's my question, right? So let me take a poll. How many of you think option one should be enough for this stablecoin to become money? Raise your hands, please. Repeat. Oh yeah, it's here. It's on the screen. Yeah. We have one. We have two. One vote. Two votes. Two votes on option one. How about option two? How many of you think you need at least option two to become money? We have more. We have probably 8 or 9 supporters of option two. How about option three? How many of you think they must have central bank reserve if they want to become money as a backing? Not many either, right? So we have a lot of non-decided audience. That's okay. That's okay, because this is not an easy question. Yeah, this is not an easy question. This is not an easy question. What I would argue is that each of the options is facing its own challenges. For option one, if you think about the money market mutual fund fiasco during the global financial crisis, 15 years ago, 2008, you will realize that, money market instruments, they are no longer NQA because they could collapse, right? So if you're not backed at NQA, yourself may not be NQA. That's the point, right? So if you're not NQA, you're not money. You can be a money market mutual fund. The stablecoin can be a money market mutual fund share. That's okay. It's an investment asset, but it's not money. To me, option one, option one means you can be an investment asset, but you're not money yet. You're not NQA. Option two, if you are backed by insured commercial bank deposit, it's good, right? Because, as I said, commercial bank deposit, they are NQA, right? They are insured by the government. However, there are operational challenges for this option because everybody knows in every country, deposit insurance has a cap. In the US, it's $250,000. So if deposit insurance only have 250K as the cap, for a stablecoin issuer, if they are only insured by that amount, this stablecoin issuer has a very small scale. It may not be able to realize in the kind of economies of scale that we would hope this technology can bring, right? So that means they're going to pose a policy challenge for FDIC. Are we going to have a special deposit insurance for stablecoin providers? And if not, this 250K as a cap will limit the size of stablecoin players on the market. If they want to become money, if the stablecoin won't become money, right? There is also monetary policy challenge because if you allow big players like Alibaba in China to issue stablecoin, and if you say, Alibaba, you have to back up your stablecoin with deposit in commercial bank, that means you have to deposit every dollar, every yuan you collect from your stablecoin buyer and deposit that into one of the big banks, any banks. Alibaba will say, oh, I can do that. I will be very happy to do it because I will become a very big player on the money market because Alibaba can raise trillions overnight. And they become a very big player on the money market. Commercial bank will bid for Alibaba's money. Commercial banks bid for Alibaba's money. And for some period, that was happening actually in China about 8 or 9 years ago. I mean, Alibaba was not issuing stablecoin yet, but Alibaba was allowed to become a payment service provider in China, and Alibaba was able to collect a lot of money from their customers. And Alibaba become a big player on the money market and become the second central bank, a private central bank in a way, because Alibaba could search the best price among commercial banks, And commercial banks try very hard to attract Alibaba's money. So So there is a monetary policy challenge. So as you can hear, my personal favorite is option 3, right? But option 3 also has worries because people worry about financial disintermediation, worry about bank disintermediation. That means if stablecoin issuer deposit every dollar they collect into the central bank, commercial bank is going to lose a big source of cash. And that's the worry about bank disintermediation. But I do think there are ways to mitigate that. That's what happened in China. China in the last 10 years trying to deal with companies like Alibaba and Tencent, and they attract a lot of money from their customer and really require them to deposit their e-money proceeds at the central bank. And we were able to mitigate the challenge of bank disintermediation. But those details, I won't bother with those details today. So anyway, there is no agreement right now in terms of what kind of backing is needed if we want to introduce this new animal into the monetary and banking room in the House of Finance. There is no agreement yet. And a related policy is a crypto asset. Should we allow crypto asset to be called stablecoin if it is not NQA? Because stablecoin can be very misleading, right? Because we know many of the stablecoin on the market right now, they're not really stable. And it's misleading when they call themselves stablecoin. So the question is, as a matter of policy, should we only allow those stablecoins that are NQA to be called stablecoin, right? So that's a policy question we need to grapple with. And finally, there is a question about tokenized bank deposits. There are people talking on the market, we want to tokenize our deposit. Big banks are also experimenting with it. And there is a question of which one is better. Should we allow stablecoin, or we should allow the traditional banks to issue tokenized deposit? Because stablecoin are issued by non-traditional animals, right? So some people will say, oh, tokenized deposit is way better than stablecoin. But there are also a lot of challenges with tokenized deposit, because tokenized deposit, if we want to make it a payment instrument, it will face a lot of challenges, because as a deposit, I cannot transfer my deposit at Citibank to a non-client of Citibank, right? I can only transfer to another client of Citibank if it's a stable coin. If we want to transfer to outside of Citibank, if we want to transfer outside of Citibank, we can do through traditional, Fed wire. How about a stable coin, a coin representing my deposit at Citibank, and I give that coin to Mark. However, Mark doesn't have an account with Citibank. Can Mark hold Citibank deposit without opening an account at Citibank? That's a challenge we have to think about, right? So, do we allow tokenized deposit to be transferred to non-client of the bank? And if so, what implication there is in terms of banking regulation, in terms of deposit insurance, in terms of KYC, customer due diligence? All these challenges come together. Because of the time limit, I'm going to spend the last 2 minutes on the next two questions, which is, if not money, it is security, right? Because I said many of the stable coins, they're not backed by what we think safe assets, right? If so, they're not really money. So if not really money, are they security? Because they are investment assets, right? So many of them are security because they satisfy the definition of security, right? It's a investment of money in a common enterprise with the expectation of profit, and to be derived from the efforts of others. That's a famous Howey test in American securities law, right? So there's a related question: is it a collective investment scheme? Because many of the stablecoin arrangement looks like a money market mutual fund, right? Because their asset side, they are holding liquid money market instruments, right? So they look like money market mutual fund, and the the so-called stablecoin is basically tokenized fund share in a way, right? So if we look through the, the different kind of arrangement, you realize that many of the stablecoin are very close to money market mutual funds, are very close, if they are not yet money market mutual funds. And finally, we are also facing the challenge of crypto like Bitcoin, right? Because Bitcoin, there is no backing, there is no asset side, and there is no issuer. And if there is no issuer, it is not security, right? Because security requires the issuer, right? The securities law are trying to impose obligation on the issuer and underwriter. However, Bitcoin, we don't have an issuer. We don't have an asset side, right? We don't have anything in the backing. So what is Bitcoin? If it is not money, and if it's not security, what is it? What is it? Well, in the US, I think we should at least ask, if it is not money, if it is not security, is it commodity? Is it digital commodity? Because there are futures and options based on Bitcoin, and CFTC is very good at regulating futures and options based on commodity. And can we regard the Bitcoin animal without any issuer, without any underwriter? If it's not security, can we regard it as digital commodity, and CFTC can have jurisdiction over it? And for other countries, like China, Japan, we don't have commodity law, but we do have futures law and option and derivatives law. And those laws, I think, those regulators should think proactively in terms of regulating Bitcoin. So let me conclude with three sentences. One, public-private partnership is very important. If you think about my three options about how to make stablecoin money, we are talking about with some kind of government backing. That's kind of, we would call public-private partnership. If we want to make stablecoin, if we want to make crypto part of the monetary and banking space. The second sentence is that leveling playing field is also important. Same activity, same risk, same regulation. And finally, we should do this with a sense of humility because we still don't know the answer to many of the questions that I raised today. So let me stop here and I'm open to questions. Thank you.
That was great, Bo. That was really interesting. Thanks for those remarks. I have a bunch of questions, but as I was hearing you present, I have one that's not on the list that I was preparing, which is, so we're here, you were a student here.
Yep.
You're coming up on your 25-year, right?
Yep.
1998 anniversary.
Yeah,
reunion.
Right.
So maybe you'll be here for your reunion too.
I don't know, economics department have a reunion for PhD students.
I'm not
Maybe
sure.
not.
We should, but in any case, so we're about 25 years out, but you were in this world of academia. So we're here at the Stanford Institute for Economic Policy Research. And my read among academic economists is there isn't much research being done right now on crypto. Mm-hmm. And I think one of the challenges there that may partly reflect a scarcity of data. And so I guess I'm curious, because you talked about how these different policy levers that countries have at their disposal, and there's uncertainty about whether they should pull or push this or that lever right now. A lot of how we build up an evidence base in economics is we do these studies, and if there's 200 different countries, maybe there's 200 different approaches, and country X changes one of its levers, and that helps us learn. So can you talk a little bit about, like, is there, from where you sit, you obviously at the IMF, you have access to lots of data, and what do you see as the sort of potentially interesting, useful data sources? Obviously, it's unregulated, so it's a hard area. So can you just talk a little bit about data and then sort of how the academic research community can be useful to someone like you on the front lines of policymaking? Because it's such a new area, and it's changed so much. So I'll let you start with that.
Yeah, thank you. Yeah, indeed, the data is something we think about every day when we talk about crypto. I would say two things about data here. One is that because of the whole market is not regulated, it's very hard to get good data on crypto. That is why I think it's also an argument why we need to regulate it. We need to bring them into the house if we want to have data. Because if we keep them in the wilderness, we won't have data, right? So that's the first point. But the second point is that, in fact, data is also what I think will make crypto valuable in the future. Because if you look at the experience of Alibaba and Tencent, the reason why they could be so effective in terms of financial inclusion, in terms of microfinance, precisely because they have trillions of data, and they use those data to revolutionize finance. If you think about Alibaba and Tencent, they do a lot of microfinancing work now in China, and they have changed the model of lending in China, because traditionally for banks, if you want to lend to someone, right, you have to do due diligence, right? You have to understand this person's finance. You have to know this person, right? And the traditional way of doing due diligence is very expensive. That's why traditional banks are not very good at doing microfinancing, because they can only do so much. However, companies like Alibaba, they don't do traditional due diligence. They use the huge amount of data they got from e-commerce and use those data to generate a credit score for the client. And with that credit score, they can lend. And all this can happen within 10 minutes. And it's much more efficient. And it's non-traditional due diligence. And it's so cost effective. So that's why they could reach billions and billions of customers very easily, very easily. So the point is that for crypto, they have the same promise, because crypto, if people use it, if people use crypto in payment, in commerce, those activities will generate a lot of data. And those data can be very valuable if we want to think about revolutionizing our financial services. That's actually the thing we are thinking very actively when we talk about not only private crypto, including CBDC, right? CBDC is the central bank digital currency. Right now, many countries are facing challenge in introducing CBDC to a large scale, because CBDC doesn't have enough use case. So we need to think about how to make CBDC more attractive to private players. And the way to make it more attractive, we think, is to make the data available to private players. And that data can be very valuable, as I said, to provide financial services.
Okay, that's great. Thanks for that. Okay, I'm just going to do one more question before I open it up. I have tons of questions, but I want to ask you about taxes. So this is probably was a bigger issue when it was on the way up. Coming down, not such a big problem, but I know a number of people in the U.S. and in other countries were sad that all this money was being made, but it was for the most part evading the tax authorities. So can you talk a little bit about that? Have you seen, from your experience, any suggestion that this will end up being sort of a part of the tax system?
Yeah, there are some efforts already in some countries in dealing with the tax issue of crypto, because it's evading a lot of taxes. For example, some countries regard crypto as money, even though in economics they may not be money yet. As I said, right? They're not NQA, so they're not money in economic sense. But for tax purposes, it is actually money in several countries. And because the tax authority want to get at the usage of crypto, so they regard crypto as money for tax purposes in several countries. So that's my first point. My second point is that for in order to solve this tax challenge, I mean, I have seen different proposals from academics, from policymakers, how to make crypto be compliant with tax regulation and also with other, of course, regulation. One of the key challenges that I said is the faceless, right? Because it's anonymous. People use their pseudonym to buy and sell crypto on the internet, and there is no real name, and their identity is not checked. There is no checking on their identity. So there are different proposals in terms of how to create the kind of infrastructure, the kind of blockchain that will be compliant for tax and other regulatory purposes. And there is a very good paper by a professor from MIT, I forgot his name, on his suggestion on how to regulate blockchain. It's not a traditional economics paper because they're talking about how to regulate the developers and validators on the blockchain, because the DeFi space, DeFi is based on this so-called Ethereum blockchain, and people are talking about how to make that blockchain regulated to comply. First of all, to check the identity of those internet IDs who want to access this blockchain, and apparently technologically it's doable. To in terms of, I mean, the validators, they are called the nodes on the blockchain. They are keeping part of the record of the blockchain, and the validators, apparently, according to some authors, the validators should be regulated, and they should have legal obligation to check the identity of the internet ID of those people who want to access this blockchain. And this is one example of people are trying to figure out how to make this new DeFi space regulated in a way that will be compliant with both tax and other regulatory requirements. But there are many different proposals. And this particular one, I think, is very interesting. I can send you the reference, a very interesting paper by two professors. One is from MIT.
Okay, great. All right, well, thank you for that. So now let me open it up to see if there are any questions from the audience. I have plenty of questions, but Jeanette, why don't you start? Do we have a mic? Should we get a mic? Yeah, if we get a mic to her, that'd be great. Hang on one sec, Jeanette.
Class teaching voice.
Thanks.
So you seem to be suggesting, you certainly are suggesting regulation, but at the same time you seem to be suggesting that crypto solves a problem that the existing regulated financial system cannot do. So your Alibaba example and credit scores and whatever. What problem really is crypto solving? Would it not be that you could take the existing financial system, change the regulation of the existing financial system, and meet the needs that it's solving? And related to this, I don't usually ask questions this long, but related to this, you seem to be also implying that crypto works for countries that don't have a well-established financial system. This seems fraught, right? That you would end up having two solutions to the same problem.
Thank you for that. I think both questions are very good. For the first question, I briefly touched upon it, but let me elaborate a little more. The question is why we should bother with these non-traditional players if we can have traditional players to be able to use crypto. Like a lot of like JP Morgan, Citibank, they are also experimenting crypto technology right now. And why do we need to bother those non-traditional players? We should let them stay in the wilderness and burn, right? We should not let them into the house. My my experience and my I think reasoning shows that, as I mentioned before, traditional financial institutions, they can experiment. I mean, we're also encouraging them to experiment, no problem. But what we have seen so far is that traditional banks, traditional financial institutions, they don't have what we call new use cases. What do I mean by new use cases? They don't have e-commerce as a big, huge amount of millions and trillions of transactions every day that could make those technology highly efficient and highly inclusive. And they don't have this social network like Facebook that could connect to millions and billions of people very quickly over internet and would allow them to utilize this new technology, new service at zero marginal cost almost, and has so many what I call use cases, because Facebook, Alibaba, they provide a lot of opportunity for people to transact that traditional banks, they don't have this kind of use cases. They have to rely on, e-commerce companies. They have to rely on, social network to be able to use their tokens if they want to, produce a token that can be, very conveniently used on the internet. So, and because of that, traditional banks, they have some distance from the new, what I call internet age, the cyberspace age, where a lot of non-traditional use cases are deployed. Traditionally we go to department store, we go to supermarket, but now people buy things online. And traditionally we meet people, in physical parties. Now we meet people online, right? So all these new non-traditional, what I call use cases, that will generate new use for technology and new saving on technology that traditional banks, they may not have access to, or they may not be very familiar with. They may not know what's the best way to utilize the technology and the data so that innovative financial services or innovative other services can be provided. So because of that, I'm a believer that we should allow both, of course. We allow banks to experiment. And banks have to partner up with technology companies because, as I said, they don't have use cases. But we should also allow technology companies to try, because as we have seen from not only Alibaba, from many parts of the world, that technology companies, they bring use cases into financial services that in a way that we did not know what could be possible beforehand. I mean, the banks don't know either, right? It will create a competition to banks for sure. Banks will feel a lot of pressure. However, without we open that door to non-traditional player into the crypto space, I'm worried that we're going to lose opportunity. We never realize, because we don't see it until they make it happen, right? So that's why we should, I always argue we should keep an open mind for technology companies to play a bigger role in the financial service sector, precisely because we don't know what's going to happen. We don't know what's possible, because traditional banks, they're not familiar with this new technology and new environment. So that's my first question. I forgot your second question, sorry.
A little shorter.
Right.
So I was asking if you were proposing that crypto was a solution for countries that don't have a well-established financial system.
The answer will be no, because I think my presentation today is based on countries with sound monetary and financial system. If you don't have a sound, a credible monetary and financial system, if you, just like El Salvador, right, they allow crypto to be legal tender. As you said, they are going to invite, they try to fix one problem, but they invite a lot more problems. So for countries with weak monetary and financial system, we would argue that they should work on strengthening their traditional monetary and financial system first, before they want to, take advantage of this new technology.
Great. So with that, I think we're just a little bit beyond 6. So as much as I'd like to get more questions, I think we need to wrap. If you have questions, is it okay if people come up after with their questions for you? But please join me in thanking Bo Lee for taking time out to spend time with us today.
Thank you.
Thanks, Bo. And please also be on the lookout for more event invitations from CPR. We have some more exciting stuff coming down the pike in a few weeks, although we don't have the final approval from that person's boss to make it official. Anyway, but we hope to see many of you at our economic summit in 5.5 weeks too. So have a great evening. That was great. Thanks so much.